Hey everyone, welcome to the KE Report and another market daily editorial on Thursday, May 29th. Now chatting with Dana Lyons. Dana is a fund manager and editor of the Lyons Share Pro website, which I see the Lyons Share Pro running a special right now. I will post a link in the show notes for you to take advantage of that special and follow along with what Dana's trading. Dana is an active manager who really is looking to use his internal models to play these markets. And Dana, I have to say, you have been on the right side of a lot of these trades, whether it's bullish or bearish. And let's just start there. From a broad market perspective, the markets, yes, they're continuing to be volatile. That seems to be the theme of this year, but S&P's back to about 5,900, a little bit off of its highs of about 6,150, but hey, that's after a 20% decline, then a 20% rebound. So as we stand right here, market-wise, are you bullish, bearish, or are you neutral?
Yeah, our models, forget what I am personally, our models are bullish right now, so we'll always defer to that and learning the lesson long ago that our objective and quantitative studies are much smarter than our human natural tendencies. So my gut is bullish, but more importantly, the models are bullish right now. We think there's more to go, perhaps significantly more to go to this up move that started obviously coming out of that washout in April following so-called Liberation Day. But just to rewind a little bit further, as you mentioned, being on the right side of both of the big moves really this year, back in December, January, when indices were testing all-time highs, we did detect, or our models detected, deterioration below the surface in a lot of the broader internal measures of the market, and did get us defensive ahead of the big washout, the big correction that we saw into April. And then again, that we saw within the depths of that washout, really historic levels of selling pressure and quote unquote give up or capitulation that has always led to not just a snapback, but typically a further rally, further up move, which we see coming forward in the intermediate term. So we're geared up for that.
Well, Dana, within the domestic markets first, I know you see some opportunities internationally as well, but in the domestic stocks in the US, what sectors do you think are showing the most relative strength that you have, alongside bias to?
Sure. What we like to see, especially coming out of a correction like we saw, we like to see what holds up the best, and we also like to see what snaps back the best and retraces the most of its correction, or preferably all, and then all of its corrective moves, and then moves on to new highs the quickest. So there are a handful of sectors which we have been on and rode out really the correction, just hedging them with other areas. Sectors like aerospace and defense really blasting off to new highs, no pun intended there. Industrials have snapped back quickly to right back to the former highs. Utilities, some of the utility ETFs have bounced right back to all-time highs. Some of the financial names, insurance, consolidating near the former highs. So these domestic sectors that have held up great, and like I mentioned, snap back and retrace their losses the quickest. Those are typically the ones that will lead in that next move. So those are some of the ones we're focused on. And even, large cap growth, which really got pounded the most. Some of those areas within that sector have bounced back and are right back up close to the former highs. And within technology, even something like cybersecurity, right back to the former highs. And these moves should be setting up, maybe after consolidation, cooling off, should be setting up another breakout, new up leg to their post April rallies.
Dana, there any correlation between these sectors in terms of, I guess, how we can tie it into sentiment if we're in a truly risk-on bull market, or if it's a market that's more focused on a different subsector of these stocks? Just any correlations you're seeing between the sectors that your models are showing you have the best potential from here?
Honestly, not really, and we don't necessarily try to look for some correlation or some sort of a tie-in. We just go with what's working, and to be honest, I like when it's kind of a wide array or a wide swath of various and varying market segments that are performing well. You have a handful of growthier names, then you had a handful of value names, which again, in the long term, I think value reemerges as the leader over growth. But you got a handful in both camps right now, which to us, it makes for a more robust environment, a more robust potential further up leg because you don't have really just one area that's subject to maybe some tape bombs or some news or headlines that come out that take all of the leaders down at once. When you have kind of a wide and diverse array of leadership, that makes for really a more, like I said, a more robust and a more stronger foundation under any further rally that we see.
Well, Dana, that's the beauty of the models is that you can use that data and not get hung up in intermarket analysis or correlation. So I appreciate that angle that you bring to the table here. You also are seeing certain things in your models internationally that have your attention and continuing to blast higher. Which markets overseas have your gaze right now?
Yeah, and that's an increasingly strong focus for us as international markets, which have really, many of them held up pretty well during the correction, and even more of them have bounced back even stronger during this recovery. So you have, again, a wide array of international markets. You look at Canada, which has bounced back nicely. The Japanese ETFs have bounced back strongly, have started to break out to all-time highs, even leading the way ahead of their cash indices. So ETFs leading the way there, something like Argentina that we've been on for a long time that continues to perform to some of the broad indices like the global Dow or the EFA, which have made their way right back to challenge or surpass their former all-time highs. But I guess probably the one region around the world that looks best to us right now for whatever reason, and it's all technical. It's all based on price performance is Europe. Europe has bounced back extremely well, very strong out of the April correction. You got Germany back to all-time highs. You got Italy hitting new highs. Some of the UK ETFs back to new highs. So again, a wide array within the European region of funds and markets that are right back to new highs. So that is increasingly a focus for us for additional allocations, especially into any pullbacks towards those breakout areas or towards those launch points. So yeah, that's certainly a focus for us for any further deployment of some of our cash that are still holding on to, waiting for better entry points.
Is this a theme we should be paying more attention to, Dana? Because as much focus as everyone gives to US markets, and fair enough, right? A lot of our audience lives in the US. US markets are the largest out there, and they have performed the best over the last few decades. But yes, the US markets have bounced back after the whole Liberation Day crash. But the international markets, while they dropped, it almost looks like they have bounced back stronger. So is this something that we can make more of a longer term theme where this catch up trade of international markets to the US is here and could be here for a while?
That could be the case. We always have the tendency, especially like you said, after the US has led for literally decades and decades, to expect that mean reversion from some of the international markets. And I mentioned the value versus growth relationship. After growth has led for a couple decades, the tendency is to think that every turn in value perhaps represents a longer term secular shift there. But at the end of the day, we don't know if that's a longer term shift. What we do know is that's happening right now. So in the, I guess, intermediate term realm in which we live, our models live, which represents, basically a duration of months, anywhere from 2 to 6 or 9 months, sometimes longer. That's what we're focused on. And within that duration, those international markets are working right now, and we expect them to continue to work at some point. Would not surprise me to see various regions around the world really represent a longer term or a secular ratio shift versus the US, which again has led for a long time. Just from a money flow standpoint, it's hard to maintain that leadership forever. Everything has its season. So eventually some of the international markets will take over that leadership mantle. But really, that's not a focus of ours because we're really on a intermediate term perspective, because it makes no difference to us even what our longer term outlook or forecast is, because if the models shift on a shorter term time frame, we got to follow the models. So it very well might be the case, but all we're focused on is that intermediate term pocket. And right now, like I said, those international markets are working best right now, along with a handful of those domestic segments that I talked about earlier.
Well, Dana, we've talked domestic, we've talked international. I'd be curious what your models show for the medium and intermediate term in the precious metal sector, another sector that's been doing well. How are you looking at gold and also the gold equities?
Favorably still. Gold has not done anything wrong yet. Certainly got extended and has gotten people very excited. I keep seeing wild forecasts where gold and silver is going. I don't know where it's going, but the trend is still up. Gold GLD, which we're invested in, has consolidated nicely. I could see another up leg there. What really has our interest right now are the miners, especially the miner ETFs, GDX, GDXJ, the silver miners SIL, which have performed pretty well. Obviously, have lagged the performance of GLD and gold, the metal itself, but also represent maybe perhaps some potential upside catch up in the future. And at least that's what the charts would suggest. After a nice bounce earlier this spring, they've done a nice job of kind of consolidating those gains, but holding on to the gains, kind of a tight consolidation or coil, potential bull flag in that near to intermediate term time frame, which to us suggests they're setting up another up leg, another breakout, and new up leg there. So I see, just from a charting standpoint, really nice potential for further gains there in the miners ETFs.
What are some of your levels that you're looking at, say for GDX or GDXJ, because they are slightly off of their highs, but again, these are multi-year highs that they are up to. So how high could something like GDX go?
GDX, after consolidating here in the upper 40s, I'd be looking for a move into the low to upper 60s would be the next level I'd be looking for, which, it's not like it wouldn't make any headlines, but it's still, a good 20% move from here. Same thing with GDXJ. I'd be looking after this consolidation, a breakout above perhaps that 66-ish level could bring us up into the upper 70s towards that 80 level. Would be a nice move there. And then if you're looking at SIL, the silver miners, a breakout above this 43-ish level, that might bring us up towards the COVID highs up in the lower 50s range. So again, would be north of 20% move, which again, it's not the sexiest thing, but it's a pretty darn solid move from an investment standpoint. Certainly would take that.
Well, Dana, another commodity sector a lot of folks listen to the show follow is the uranium sector. We had talked about that previously. We talked a little bit about it off mic. Curious to get your thoughts. There's a lot of people already calling the top on the move that just got underway. It's been a quick rebound back. How are you looking at something like the uranium sector?
Yeah, URA, we're playing the uranium sector via URA, which obviously has had an explosive move over the last week or so. We had been trimming a little bit, which we saw some resistance around that 28 range. Blasted right through that. Again, no puns intended here, but blasted right through there, back up towards the highs that we saw over the last year, actually the last 3 years or so. So I think that some of that move was kind of newsy related, and which would it just in the short term get me a little bit skittish about chasing right now. But the fact that we have retraced that entire pullback from the end of 2024 right back up to those highs, that has me more excited again. And I would love to see some sort of a retrenchment, consolidation. Again, no pun intended, but a refueling here in the short term that might set up a nice breakout above, eventually above that 34 range, pushing up into the upper 30s, maybe 40 next, and then who knows after that. But it does right now, similar to the miners charts, it does suggest that after some cooling off here in the short term, it does suggest a breakout and potential for another up leg above those former highs. So that's what we're gearing up for.
All right, Dana, a lot of opportunities out there right now in some commodities and also international markets, also some other sectors within the US. This has been, again, a strong rebound. We don't know where the next catalyst is going to come from, especially when it comes from the political side of things, whether good or bad. But right now, maybe a little bit of calm over tariffs, over all this fighting with other countries. We do need to remember markets do have that bias to the upside. And right now, we'll just see if even the broad averages can make it back to those all-time highs. Again, Dana Lyons, fund manager and editor of the Lyons Share Pro website, which he is running a special. So be sure to click that link in the show notes to sign up for Dana's service and be more on top of your portfolio. Dana, thanks as always for your time today.
I appreciate it. Always a pleasure, guys.